Welcome to the Multifamily Investor Nation podcast. I'm your host, Whitney Elkins Hutton, Director of Investor Education here at PassiveInvesting.com. And I'm excited to be joined today again by Brian Briscoe. Brian, welcome back to the show.
Thank you. I appreciate it.
Excellent. Well, Brian, we are going to deep dive into Eleanor Rigby Apartments, 43 units in downtown Salt Lake City, Utah. I'm excited to hear that story because we have some challenges there. I know that you've already alluded to already before the show. But
There's
before we do that,
always challenges. I mean, it's yeah. So
right?
anyway, yeah. Before we do that, sorry.
Before we do that, let's dive in. Just recap a little bit for the audience if they haven't listened to your previous episode, who you are, how you got into the multifamily space, and where you're at today.
Yeah. So Brian Briscoe, obviously, I probably didn't have to restate that, but who cares? Grew up in Utah, and so buying things in Salt Lake is my backyard. Um, Very roundabout way of getting there though. Right after September 11th, I was in grad school and ended up joining the Marines and doing a 20-year career. And that's, in the military, that's kind of what got me into real estate investing. The military lifestyle, we would move every 2 to 3 years. Sometimes I think the shortest time we were in one spot was 9 months, right? So on average, 2 to 3 years is how long we'd stay in one spot. And I didn't have a really great financial education, growing up. And I was looking at everybody saying, buy your home, buy your home, buy your home, equity, 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 right? And the problem was we were sitting 2 to 3 years in a spot, and it's just like we're never going to build up equity if we keep on buying and selling and buying and selling. And so what did I do? I bought a home and thought, you know what, we're just going to put renters in it when we move out. That way I can start doing it, getting some equity. And so that's what we did. And then we moved and it's like, well, let's do this again. And so that was the plan. And it was just kind of, I wouldn't say it was accidental, it was definitely deliberate, but um, over the course of, 10 years, I was able to get 3 properties, right? I mean, so it's not like I had a huge portfolio, but what I was able to see is the equity buildup. We had cash flow, we had, all the things people invest in real estate for. And this would, when we start looking at timeline, now we're sitting in 2017, 2018. I've been in the military for, 15, 17 years, and I'm seeing the light at the end of the tunnel. The military retirement is a light switch at 20 years. You can retire at 20 years and get a pension for the rest of your life. And I am a military retiree now. Pensions are awesome. But I started thinking about what was next. And really what I wanted to do was more real estate because that excited me. Every time I moved, the prospect of buying a new place and, turning it into a rental later was absolutely fascinating. And basically, I started doing numbers and I couldn't buy single family homes fast enough to hit my financial goals. So I decided to do apartments, and at the time I was saying it's a kind of a buy one, get 20 free sale. It's you go buy a 20 unit and um, it's almost equivalent of 20 single family homes. Not really, but that's how I was thinking of it. And so got into a coaching program to help me do it because I wanted to accelerate things. Found a couple of partners and originally started buying properties in South Carolina and Georgia. Um, when I retired from the Marines, I moved a lot closer to home. I'm in Idaho Falls right now, just north of Salt Lake City. And about a year ago, refocused acquisitions on Salt Lake City. Just I'm here, I'm close. It's, an area I know and love very well. And, it's a great market too.
Awesome. Well, I'm excited to dive into this transaction.
Yeah.
So let's get to it.
Yeah.
Eleanor Rigby Apartments, 43 units, Salt Lake City. When did you close on this property and what was the purchase price?
October 25th last year, 2023.
Awesome. And how much did you pay for it?
10.1 million.
10.1 million. Is that what it was listed for?
It was, well, we originally saw it at 11. My understanding is It was listed higher prior to, so and I think it was happening in a lot of places. Owners would come out and say, hey, we think we can get 2021 prices, and this was 2 years later. Rate hike started in March, and prices had declined significantly. So I think it was originally listed at like 12 or something like that. But when we first saw it, the number was 11.
Okay, so you saw it at 11. When did you first see this apartment complex?
May. So we saw it in May of last year. Very coincidentally, I had hired somebody to help me with acquisitions, to underwrite and everything else. And this is like the unicorn never happens. This was the very first property that he opened up and underwrote, you know, and it's just like one for one, how do you beat that? But so yeah, we saw it in May, and this was kind of like the one that I was sitting down with him, walking through underwriting, and when we get to the bottom line, I'm scratching my head. I'm thinking, this is actually a good property. I'm like, this is actually a pretty well priced. So yeah, that's when we saw it. And I mean, it took us a while to get the offers in and contracts signed and everything else. But yeah, May-ish. Yeah.
Okay, so May, was it listed with a broker? Was it off market? Like, how
It
did
was
it
it
come
was
across
with
it?
the broker, and it was the brokerage was Bercadia, and I mean, I don't think I've seen very many full OMs from there. There was like a couple of 4 or 5 pages worth of kind of marketing material. So I don't know if it was fully marketed, but I mean, it we're going to call it a marketed deal. Yeah.
Okay.
Yeah.
So marketed deal listed at 11. You saw it in May. How long did it take you to get it under contract? And how did you win the contract? Did you have competition as well?
Well, that's kind of the thing is, there wasn't a lot of competition. And right now in Salt Lake, there are not a lot of people willing to buy right now. And there's not a lot of people willing to sell. And I think, transaction volume kind of dropped through the floor. And these sellers, they weren't having a problem with this property at all. Okay. Just a little bit more about kind of where the sellers were sitting. They bought the property, I want to say in like 2019, 2020. They did a value add. They put a lot of money into it, and it's just really a beautiful property. And they got permanent financing on it. I want to say late 2020s when they got permanent financing on it. Um, but they had a 3.1% interest rate. Okay, so what made it attractive to us is it had a 3.1% interest rate. Why they were selling is because they had a couple other development projects that they were running, and most construction loans are variable rates, and SOFR had gone from like 0 to 5 by then, and so they were pinched on a couple of their other development projects. And so their idea of, keeping things running on one side was just, hey, let's sell one of our properties. So yeah, we walked in, they were asking for 11, and maybe a little indicative of how much they wanted to sell. We made two offers. I like doing two offers. We made two offers. One was, conventional. We assume your loan and we give you cash, for everything else at closing. Option two, we floated like the seller leaves like $1 million in, pref equity in there or something like that. Um, so we gave them two offers, and the conventional one was at 10 million. They countered us 24 hours later at 10.1, and usually, if their price is 11, you know, and I come in at 10, I was expecting them to come back at like a 10.8, not a 10.1. And I think on this property, we were willing to pay up to 10.4, 10.5. That was kind of my line in the sand, but they came back at 10.1 on their, and they didn't change any of the terms, anything else. It was just 10.1. And so we started looking at the numbers and we're like, I think within 30 seconds, the broker giving me that information, I'm like, yeah, set it up for signature. I'll sign that right now. So,
Mhm.
but yeah, that's and I think
So
you
how
know,
did you structure the offer? Was it a 30-day due diligence, 30-day close, any extensions?
yeah, 30-day due diligence, 30-day close, 30-day extension.
Okay. And then did you have any earnest money down on this property? Was any of it hard?
This one, let's see. We had 100,000 earnest money that we put in, and it didn't go hard until after the due diligence period. And then we had $100,000 for the extension fee. And I intentionally, I mean, 1% of EMD, 1% is EMD isn't bad. Usually the extension fees are a little bit lower, but I went with a higher extension fee. But yeah, so that's what we ended up doing as far as the contract goes, 30, 30, 30.
Okay. And then let's talk about the physical due diligence of the property. What vintage is this? You mentioned a developer was selling it. Like, is it pretty new?
No, it's a 1929 vintage. So they went in and gutted it and basically did a full rehab. I mean, brand new plumbing throughout the building, which is really, really nice on something that old. Brand new electrical through the entire building. So yeah, they redid plumbing, they redid electrical, they redid all the finishes. And then it's just this really beautiful, 1920s building, and the 20s was the decade where everything was ornate, and everything was just beautiful and architecture was in full bloom. It was but just a really beautiful kind of red brick building with some really fancy trim and windows and gables and I mean it's just a really pretty building on the outside. And they did an amazing job on the renovation. So I remember, what my first walk through the property with the broker, my opinion, I'm like, I honestly didn't see anything wrong with it, I mean, usually you're going through and I mean, um, especially with the age, I didn't see anything wrong, it's just like, so yeah, our due diligence, we obviously went through every single unit. And the level of work the previous owner did was, very consistently high quality. Talking with a lot of people that know it's another Salt Lake group. And so talking with a lot of other people that know these guys, I've heard several people say if they have one flaw, it's over, doing too much. So yeah, we went through and we didn't find a whole lot of things, so we did get up. I mean, we got up on the roof. There were a couple of flashings. There was one spot on the roof where it's the TPO membrane roofing where it wasn't sealed to the side very well. And so just kind of how good these sellers were. The broker asked us, hey, did you find anything? And our answer was not really. I'm like, there was this one issue on the roof where the TPO had kind of peeled away from the side of from the side. And she texted me a picture about a week later of it fixed, and I mean, I don't think I've ever had any other seller do this, it's just like, I pointed out a couple of problems that we saw and the seller fixed them, just immediately. But yeah, largely our due diligence, there are a couple of things that, a couple of things on the exterior that we're still, working on. Um, we're going to put new windows in the front, and there was really nothing wrong with the old windows, except they are single pane glass and it is downtown, and single pane glass doesn't block noise very much. So we've had noise complaints, but windows was something that we were looking at anyway. And looking at some of the timber work on the front of the building, that needs to be refinished. So, I mean, we walked away thinking we're going to have to redo our parking lot in the first, first year or two. So we budgeted money for the parking lot. We knew we were going to have to do some facade works. We wanted to get windows. And so we came into this with like $150,000 renovation budget. I mean, it wasn't really renovation. It's just like kind of pre-funding our CapEx, and then the eventual CapEx burn that we would have later.
All right. Well, let's talk about the financial due diligence. How did that go?
It went okay as well. I mean, the nice thing, well, it was operated well. They weren't, I don't think they were super aggressive at pushing, rents or anything else. And honestly, I'm not super aggressive at pushing rents either. So we looked at it and we thought it was operated well enough that we kept the same property management company aboard, you know. And this is my first Salt Lake purchase. So I hadn't had property management relations yet. And so I started looking at this and talking with the property management company, going through all of their numbers, and they were cash flowing, and we're going to get the exact same loan. So I knew exactly what we were going to be cash flowing at. But yeah, I mean, their numbers were spot on. And this, like I said, this ownership group just did a really good job. They sent us everything we asked for when we asked for it, and their documents were complete. Lease audits didn't turn up anything unusual. I mean, this almost was like a textbook. Wow, that this thing is doing well. So yeah, we didn't find much of anything, at all on our financial due diligence. And I mean, we looked at utility bills, we looked at bank statements, we looked at the contracts. I mean, it's not because we didn't look, is what I'm saying.
Hmm. Well, let's talk about the financing on the property then. What kind of lending did you use on this property? Like, was it fixed rate, bridge, loan to
We
value, all
assumed the
the
loan.
nuts and bolts?
Yeah, we assumed the loan. So $10.1 million purchase price. They had 5.8 million on the note when we assumed it. It was fully amortized. I think their original loan was like 6.2 million, and they'd already paid off a couple hundred thousand in the years they owned it. So 5.8 million is the loan amount that we assumed. Now
What
it
was the
is
interest rate on that?
3.1%, And I mean, we had this sized up, and Salt Lake is a low cap rate market. Okay. And what does that mean? It means when you go to lenders that have like this loan to value cap of 75%, none of these properties ever hit that loan to value cap, and so we started sizing this up. We looked at other options. We looked at it's obviously a stabilized deal, so we took bridge off the table immediately. We looked at Freddie Mac. We went out to a couple of local banks and credit unions, and the best we could do at on that same property with a different loan product was like a Freddie Mac that was going to give us 6 million, and the prevailing interest rates at the time were low sixes. So it was assume this loan with a $5.8 million balance and a 3.1% interest rate, or getting new debt at 6% interest rate, and only get a smidgen more in proceeds. So I mean, the obvious answer was to assume the loan. There's a local mortgage shop that they specialize in insurance company loans, but they do the servicing for all the loans that they line up. So, we reached out to these guys before we had the property under contract, just to double check a couple of things. I mean, we made sure the broker and owner knew, of course. I mean, that's typically not something that people are going to give information out if they don't have the permission. But we started reaching out to these guys and verifying, hey, we're looking at this property. Can you verify this loan is actually assumable? And that's one check I wanted to do before putting putting my signature on the contract. And so we started asking them about all the fees and everything else that's going to come along with it and everything else, and it all checked out. They were going to they had a 1% or so refinance fee, which most lenders have origination fees, and so the lending ended up lining up pretty well, and it's just a matter of you know going through the assumption process. And I don't know why, but the assumption processes always are a tiny bit more complicated than getting a new loan. I've assumed probably a dozen loans and gotten about a dozen brand new loans, but they're a little bit more complicated because there's two parties involved on everything. The buyer side has to cooperate, the seller side has to cooperate. But one thing that was really, really nice about it is there was never any question about what our interest rate would be, and there's never any question about our proceeds. The only question we had is what day are we going to close and what's the balance going to be on that loan that day? So every day there was a couple $100 actually on this. Yeah, every day there was like $700 in extra interest being charged on the property. So the only question is when are we going to close, and on that date, what's the current loan balance? But it was that part about loan assumptions is really, really nice. There's no volatility on how much proceeds you're going to get, no volatility on interest rate.
So you assumed the loan.
Yep.
Was it 3.1% interest only for a
Oh,
certain period of time? Like how much
fully
runway did you have
amortized.
left?
Yeah, fully amortized from the beginning. It was originally a 10-year term. And when we closed, I think we had like 8 years and 2 months on it. So, and then there is a prepayment. They have an interesting prepayment schedule for the first 5 years of the loan term. It's yield maintenance, which is a punch in the gut if you ever want to get out of that loan. I mean, if we were trying to get out of that loan right now, we'd owe 7 years worth of interest. We're paying 20,000 a month on our principal interest payments. So it would just be a ridiculous amount of money to get out of the loan. So first 5 years are yield maintenance. And then once you hit the 5 year mark, they do a step down similar to Freddie. So it's a 5, 4, 3, 2, 1 step down. Um, so yeah, we fully amortized. That loan product didn't have any IO built into it at all. It was just fully amortized from the beginning. Simple. Sometimes
Mhm.
simple is nice.
Well,
So
and then that kind of clues me in why the seller, if they were selling outright, they would want 11 million. But if you were assuming the loan, they could probably, lower the purchase price a little bit.
yeah, I think they lowered the purchase price. I mean, we had gotten a little bit more history on this one. I mean, they had marketed this for quite a bit. Um, like I said, I think they had started at 12 and just didn't have anybody bite. And they incrementally lowered the price. And when we talked to the broker, they first said 11. I'm guessing that they had already in their minds come down lower. And so when we put an offer in at 10, I think that's more indicative of where they were with their other projects and the fact that they needed to sell quickly. And so um but yeah, so when they came back at 10.1, I was like, wow. And we'd already walked the property a couple of times. We'd already, done as much as you could without getting the stuff. But and then, I did have a couple of brief conversations with the seller through the process, and he confirmed everything the broker told us. Yeah, we got this project over here, we got that project over there. And they were completely stalled because of money. And so they're still paying interest on the loan. They didn't have cash to. So really, I think they're coming down to 10.1 quickly was indicative of where they were in the other situations.
Mhm. Well, let's talk about the raise piece of this because you did raise investor capital. So tell us how you structured this deal for your investors.
This was kind of like an idealistic thing, and it ended up making it a little harder to raise. But I I love the idea of long-term holds. All right. Absolutely love the idea. And so, this was my first Salt Lake property, and I had just pivoted, left a different company, and I've been part of, prior to this, I'd been part of, 16 or 17 different syndications. Um, and so this was like a brand new structure. We did a 20-year hold, right? Like I said, I like long-term holds. And the structure, what we pitched to our investors is we are going to refinance approximately every 5 years, right? And so we're coming in to this with an 8-year runway at 3.1%. All right. Sometime in that first 8-year period, when prepayment penalty burns off a little bit, hopefully interest rates come down and values go up, we'll refinance and we'll return a bunch of money. Okay. Um, the way we have this set up for investors is all of the profits or all of the distributions off of the property are paying down their capital balance. right? So we made our first distribution last month and everybody's capital balance dropped, so we're paying back principal. And then once we pay back 100% of the principal, we just go to a 75-25 split. So, obviously, for me, that means I don't get paid until, we pay down 100% of their principal. Um, but for the investors, I mean, I think that's better than a preferred return in a way because they're getting 100% of their money back before I make a penny. So, um, if this were like a 3 or 5 year hold, that would make me want to sell immediately. But, I'm looking at this as a 20-year hold. And when I start looking at, the economics for me, once we pay back their principal, I'm making a lot of money. So I think it ends up being kind of the best of both worlds, but it has to be, you know, it's kind of a different type of investor that wants this. I think most people in the last 5 or 8 years have been conditioned to these 3 to 5 year holds. And so we had a lot of people that just looked at it and said, 20 years, nah, not going to touch it. Um, but yeah, so I think that made raising money difficult, but um, we did it. We ended up raising 5 million, a touch over 5 million for this, and the capital raise was slow. It was a lot slower than I anticipated. Part of the reason I think is just where we were in the market cycle. A lot of people were seeing where values were going, and they were just scared. Like I said, part of it was, 20-year hold. Not a lot of people were prepared for a 20-year hold. So, um, I mean, we'll probably get into, problems later, but we did end up having to extend our contract once past the original extension date to get this done. And that was largely because we hadn't raised enough money yet.
Well, did you charge? Okay, so we talked about how you structured it for
Yep.
your investors, but you got to keep the lights on somehow. So what type of fee structure are you charging to this deal?
3% acquisition fee, and think I think we baked in a 1% fee at every refinance. And I mean, we do that because, I don't quite have the balance sheet yet for a $10 million loan. And when we refinance, we're going to need a $10 million loan. So I put a 1% refinance fee in there to pay, loan guarantors. A lot of them are going to ask for fees, when they sign on dotted lines. So I think we have a 1% refinance fee at each juncture. Um, and a 2% asset management fee based off of the revenue.
Okay. Well, as we wrap up the show, I have two questions for
Yeah.
you. What did you find easy during this process that quite honestly you thought was going to be a little bit more challenging? And then what was ended up being more challenging that you thought, heck, I thought this was going to be a lot easier?
I'll answer the challenging one first. I mean, the capital raise was a lot harder. And part of it was because it was a 20-year hold. Part of it was because it was, the first time I was marketing a deal in Salt Lake City, and most people knew me as the Southeast, 'cause that's where most of my investments were at the time. So yeah, our capital raise went really slow, but we obviously raised it all and finished and everything went well. Um, what went easier? Yeah, I mean the due diligence. The seller was super accommodating on that side of the property, and previous ownership team were really easy to work with. So I mean, when we had an issue and we needed to extend, I just pick up the phone, called the broker. Here's where we are. Here's how much money we have in the bank. I know we're supposed to close next week, but we're about 1.5 million short of five. And she picked up the phone, called the seller, came back and said, "Is a month enough?" Yep, month's enough. Okay, you got it. So, I mean, they were great to work with, which can be surprising. I mean, not everybody is. So I think that was probably the easier part, was just working with the sellers.
Oh. Well, Brian, thank you so much for joining us today and sharing your experience and insights with us. If people want to learn more about you and follow you, how can they do so?
Well, I'm very active on LinkedIn. If you want to hear what I'm thinking or read what I'm thinking, that's the best place to do it. Connect with me. I try to reach out to everybody who hits that connect button. So And then our website is streamlinecapitalgroup.com, and that has information about what we do and how to get on our investor list.
Awesome. Well, Brian, again, thank you so much for sharing your time with us here today. And we look forward to hearing about your future deals.
Yeah. Yeah, we hopefully we'll come back in a couple months with another one.
Yes, we look forward to that.
Awesome.